There it is. I think we are now live. So, welcome everybody to Vetted VA Live. We're back for another installment on our semi-weekly, pretty much weekly actual show now, evenings at 7 p.m. Central Time. And with us tonight to cover this topic of credit, we're going to talk about credit, the impact to your VA home loan, the impact to, I don't know, all the things you do. Credit has become one of the most impactful things that is still somewhat ambiguous about what it means and how it's managed and how you modify it. And it's kind of a trial and error thing. But we're going to try to shed a little bit more light on that and what it looks like. So I'm going to have my esteemed colleagues introduce themselves going around. And as I'm looking at this screen, I'm just going to move like Hollywood squares this way to Jerry Avila. Why don't you introduce yourself and tell us a little bit about yourself?
All right, guys. So Jerry Avila, I'm with True Path Loans here in California, based out of Irvine, with our branch office in Oxnard. I've been part of Vetted VA now for I guess 3 years now, basically, for the
Yep.
majority part. Yeah, 3 years. And kind of remember when it was only like a 300 or 1,300 person group, I think it was when we
Yeah.
started. And
Yeah.
yeah, I've been in the industry now since 2004. So yeah, I've been in here long enough to kind of grow some gray hairs, probably lose some hair as well.
That's why you keep that ball cap on nice and tight. I know. I appreciate that, man. All right. So hand this off to who's below you.
Anthony.
Hey, I'm Anthony Patton. I'm with Open Mortgage based in Austin, Texas. I spend part of my time in Dallas and then part of my time in Austin, and been in the mortgage business helping veterans buy houses for 30 years. And been with Vetted VA a little over a year, and
Yeah.
love the fact that we have 57,000 members that constantly ask questions so that it always makes it enjoyable to still be part of helping veterans buy houses and sell houses. And it's just a great group, and we love all of you.
I love it. All right. Kick it off that way. Down there.
It's
This guy,
that way.
Yeah. Ben Miller. Your turn.
I am Ben Miller, and I work under my branding of Ben Miller Home Loans or Ben Miller Loans for American Mortgage Network. And as far as being a loan officer, I've done that since 2013. And with Vetted VA, I did come in 2019, the original influx, and then they kicked me out because I had to get vetted. I had to go through testing, had to go through a lot of training, and came back sometime last year, at least a year ago, maybe ish.
Yeah.
But love getting to serve in this group and helping those who have served to be able to make educated decisions and get answers without getting hassled.
Yeah.
Love it. All right. Testing is hard. We've got a lot to cover. Credit is maybe the craziest thing. I was actually looking. You guys ever get something in your head? You're like, I know it's on the tip of my brain. I know the answer to this, and you can't remember it for the life of you. So, Equal Credit Opportunity Act of 1974. There's a really funny story about that, and I'm just her name is completely just escaping me right now. So I'm gonna set it aside. I got to do this mentally, physically. Okay. All right. Let's start with the basics. The credit score and the VA home loan. It seems like, depending on which mortgage company you talk to, there is a minimum score standard. But let's kind of shine some light on the truth and back up our answers with some factual representation, site sourced and delivered. I'm going to toss this one over to Ben first. Ben, what is the minimum credit score to apply for VA loan?
There isn't one.
Now, how do we know that? Where's that come from?
We know that because all of the guidelines for getting a VA guarantee on a loan guarantee certificate, are in the we always call it the VA Lender Handbook. I think technically it's a 26-7 pamphlet or something like that.
Technically correct.
But inside there, verbatim, there is no minimum credit score.
Yeah, chapter 4, no minimum credit score. So, in lieu of a credit score, what are they looking for? What does the VA want to see in lieu of a credit score?
They want to see the credit worthiness, ability to repay. They want to see, there's no, you hear a lot of people talk about you need this many trade lines, you need to have X amount of months. And it really, there's a lot of discretion to be able to extend credit to credit-worthy individuals without having to put them in a box of it's got to be 12 months, it's got to be 3 trade lines, it's got to be, there are some hard and fast rules, but when it comes to the credit, it just you have to be able to show that you are going to be responsible enough, and here's the evidence. I will make my payments. Here's how I can show you that.
Yep.
That's the
Anthony, like, how are they proving that you can make your payments on a regular basis? Like, what are they looking for specifically there?
Payment history. That's going to be first one.
Right.
When it comes and when it comes to late payments, what is a late payment? A late payment is a payment where you missed the actual payment, where the next payment was due. So typically that's going to be 30 days. Now you may incur a late charge, but as far as it being reported as a late payment, that's going to be when you missed the payment when the next payment came due. So typically that's going to be, we call it a 30-day late, obviously, or 60 or 90, but they want to see a history of on-time payments. So if you don't pay, if you didn't get to pay that car payment till 2 weeks past the due date, but you had it paid in before it rolled over to the next month, you're not late by the credit bureau. So don't sweat that. Stuff happens, right? But the history, it's hard to establish anything in less than 6 months.
Yeah.
We'll throw out a lot of stuff. You can show a lot of strength over 12 months. So even though it's not so hard and fast, it's still a good, the parameter is going to, there is technology involved. So the more on-time payments you have, you're going to outweigh the anything that you missed.
So to that point, Anthony Patton, I want to pick on you for a second, right? I'm going to toss this your way. So in the handbook, chapter 4, section 7 is exactly what we're talking about, Ben. And in section 7, it says, you have to look at, like, the underwriter has to review a 3-file merged credit report, an MCR, or a residential mortgage credit report. And it must be less than 120 days, but it says 0. In fact, on this next page down, it says VA does not have a minimum credit score requirement. So why in the world do we say, or do people say, well, I can't get one with a 480 credit score? Like, where's that coming into play?
Yeah, so there's 2 things at play there. No credit score is different than a 480 or 500 or 520 credit score. So no credit score is no credit score on the tri-merge that the underwriter is looking at. And so we can build credit using insurance, cell phone payments, water bill, electric bill. We can build credit that way to show credit worthiness.
Yeah.
When you're talking about a 480 or 550, usually what you get there is negative credit history. It's not a no credit, it's bad credit history. And still VA says you don't have a minimum credit score. And so most lenders look at a minimum number, 560, 580, 600, and it is that particular lender's, what we in the industry call overlay. It is that lender saying, even though VA says they don't have a minimum credit score to insure us, we personally at XYZ Mortgage are going to put a hard stop at most of it's 560, some are 580, some are 600, some are 620. And what they're saying is their history of buyers below that number has been a negative experience. And so they just say, we're not going to lend to those people.
Right.
And so hopefully, tonight we're going to talk about that is, where, whatever your number is, how do I get higher? And I think to your point is each lender is different. They will have a different hard line where they won't go below that. But it's not VA, it's the particular lender you're dealing with, right?
Yep. So the VA doesn't have a minimum credit score. They do have some minimum credit qualifying activities, right? You have to have minimum credit data that's showing, and they have a section. So it's chapter 4 of the 26-7, section 7, subsection B, and it talks about adverse credit data. Jerry, can you walk us through what like adverse credit data is? What are they looking at that would affect your score, right? Ultimately, they're saying, if I had adverse credit data, I'm going to have a low score. But what exactly are they looking for?
So they're looking at payment consistency. They're looking at past credit history. So based off of bankruptcies, collections, all of that comes into play. They're considering every factor when it comes to what your minimum score is. So if you've shown a consistency of inconsistency, that becomes more of a factor for them to say, well, you know what, time and time again, this has proven not to be something that this individual may be capable of doing. So the way to kind of counterbalance that, in a sense, is showing a 12-month history of on-time payments and on-time history. So that way it kind of gives that stability now for showing for the last year. They haven't missed a single payment. Everything's been good. There's no new derogatories. There's no new collection accounts that are being opened, no new judgments. So everything that comes into play there now gets, in a sense, not necessarily wiped, but it does get looked at as, okay, that was the past. Something has happened now. And if anything, they may even ask for letters of explanation, just wondering, okay, well, what exactly occurred back then that has now been fixed that you can tell us with assurance that this is not going to be something you're going to fail at making those mortgage payments. So, it's just they're looking at every aspect of it, because what they want to do is they want to reassure themselves that at the end of the day, that client, that particular veteran, is going to qualify for that loan and then also be able to fulfill that loan at the end of the day.
All right. So we get there, we talk about like score, but while the VA doesn't care about the score, they care about the history. The history drives the score, right? Ben, you were just citing something off. What makes up a score? You kind of were looking up and doing some research now, the percentages of your report and kind of how that weighs into your score. Walk us through that.
1 second and I'll call it up.
Okay. I should have given you more of a heads up. Like, hey,
it's all good.
Ben,
we're live. So the percentages of what is in a score, like what is in a report, not a score, but what is in a report, how does it affect your report? How does it affect the score? So I'm going to go from the highest impact to the lowest impact. The highest impact, which is 35% of the credit score, is payment history. That's no surprise, right? What specifically payment history? 30-day lates, anything above that, right? Mm-hmm. That's the number one part about payment history. The next one is amount of debt. That is a 30%. And I want to clarify what that means by amount of debt, because as I'm looking at mine, it's actually telling me like, this is my personal report, and it tells me what my revolving utilization is. And what that means is, let's talk about credit cards specifically. $5,000 credit card, that's your limit. If you're using if you got a $2,500 balance, you have a 50% credit or revolving utilization. It's not an exact science, but if you keep that under 30% of credit utilization, That doesn't mean that you don't ever go up to 5,000, but that means that you are keeping your statement balance below a certain percentage. Obviously, the lower the better. They do want to see you. There's a word in there, utilization. They do want to see you using it. Like people who charge interest enjoy you using their products. That's just how it works. Then the next one down is length of credit history. That has a 15% impact. So it's not quite as impactful as the rest because, my son is 19. Jerry and I were actually talking about this today. And I put him as an authorized user on a credit card I have. And he's never bought anything in his life. And he's mid to high 700s right now he has no income, so I wouldn't loan him anything, but he's got a good credit score. But his credit history length is kind of short, but you can see, it's about, I'd say just under 2 years, but he's got a pretty good score. So it's that 15% definitely isn't impacting him that much. And then the other last two categories, which are 10% each, is amount of new credit.
Right.
So like the age of the most recently opened account, the longer, the better. It's kind of interesting, but they do want to see that algorithm, so to speak, does want to see that you do use credit. And then credit mix, that's 10% that makes up the rest of it at 100%. And credit mix is just different types. You've got a mortgage is a mortgage. And then if you go buy a car, it's kind of like a subcategory. It's an installment loan, but it's also an auto loan. So you could also have like a student loan, which is an installment loan, but it's a student loan. So you've got a bunch, credit cards are revolving. There's some different mixes in there, and the more you have, you fill in that gap there.
Well,
So
and
payment
let's
history.
clarify. So you're talking about revolving credit, like a credit card. That's where you charge something up, you can pay it off, and you still have the same, like you said, an amount of credit you can charge on that line, but it changes, and you can manipulate that. An installment loan is usually like, here's a set amount of money we're going to loan you on one thing, like a student loan, right? I have plenty of those, just being totally honest. And I
You
got it
never
one
want to-
time. I didn't get the money. The money went to the college, but it was for my student, right? But I don't get to draw against that in the future. So same with an auto loan, installment loan. You can have unsecured line of credit, which might be like a bank. It's almost like a credit card, but you can pull from it and you can lock it in at certain times. You can have home equity lines of credit. You can have, you name it, right? There's lots of different types of credit lines out there. Let's talk about like the score and adjusting. Like you're talking about playing with balances and stuff. Anthony, walk us through, if you would, writing a mortgage on carbon paper. No, I'm just kidding. I've been in the industry long
Got
enough. Like I know.
And faxing it in.
I was going to say you fax
I
it,
wanna
man.
go
He had
back
to
to
walk it
something
down the
Ben
bank. Okay, go for it.
Yeah, so back in the day, you had to take a VA loan and you typed it out on a typewriter with carbon paper,
Yep.
and you would stack all that up and deliver it to the VA, and it was a mess. We don't do that anymore. One of the things Ben said, though, that I do think is important to touch on when we're talking about credit utilization is the credit score is made up of the entire credit of all of your credit. And if you have 3 credit cards and one of them is at 85% utilization and the other 2 are at 0, then that's okay because your overall utilization is lower. But if all 3 of those credit cards are at 75 and 80%, that is going to be a negative draw on the score. And if anything is at 100%, or I went over my credit limit and now I'm 110% balance, that is really going to draw down the score, because the algorithm looks at that and says, this guy's in trouble. He's charged over his limit. He's having financial problems. It's going to have a negative impact on the score. And so you really want to be aware of, what is my balance? What is my credit limit? and how those things can be adjusted to impact your score. I hope that makes sense.
Oh, I'm pretty sure, as long as we've all been in it, that you can see a direct correlation between a missed payment and a high revolving, like as far as really anchoring your score down.
Right. Yeah. Yeah. That wasn't what
That
you were
is-
going to ask, was it, Nathan?
No, but I mean, but that's really true. So let's actually keep going down that line a little bit, Anthony, and talk about manipulating or simulating score changes, right? Because the beautiful thing about credit scoring models is that they're built by people much smarter than me, and so I can never understand it. However, now there are tools where I can try some stuff. I can say, hey,
Right.
I just came into $5,000 because I did, and I'm going to pay off a credit card. What will that do to my score? Or I'm going to trigger or I'm going to take out a new line. What would that do to my score? Like, walk me through that. And if you're catching this and logging on to this, like, make sure you let us know. Hit hashtag live, hashtag replay. Ask your questions in any of the chat windows underneath this video. We want to deal with those live. So sorry for that, Anthony. Go for it.
That's all right.
Walk us through
Yeah,
that
so
simulations.
The great thing about the fact that the credit score is a hidden super secret algorithm is that it can also be manipulated, and if you use like the Vetted VA Go Bag, you go to our Vetted VA website, you go and get your Go Bag. It has in there a tool that what we in the industry call it a what if tool, a wayfinder tool, and it is based on your credit profile. What if I did this? And so the system will run the algorithm and it'll give us an idea of, well, if you do this, if you pay down this balance, here's what the score will do. If you pay off this loan or pay off this collection, what would happen to the score? Vetted VA has that Go Bag. We as lenders have a very similar tool. When we pull your credit, typically it'll tell us what your scores are, and then our tool below that tells you which way is the score trending. Do you have a 620 score and it's trending to be a 640 or a 660? We can click on that and it'll give us the what if scenario of if you paid off this, or I have a client now who's a 617 credit score. I clicked on it, and what it said, to Ben's point, he had a JC Penney account that he had since 2016, and it had zero balance all the way across it. And the model said, if you'll go put $10 on that, your score will go up 22 points. And it's because the algorithm is looking for, in his particular case, it looked like to the algorithm that he had no pay history. And so it couldn't give him a good score because he didn't have anything to verify that this guy could pay. And so
was he able to find a JC Penney though? That's my question.
It was a JC Penney account. That's what the system wanted him to do. And so I called him and I said, go to JC Penney and buy a pair of socks, dude, because that's what the system wants. And so we can use that. The Go Bag has that. You can use it. You can go in and play with it and see how to adjust your scores. It's a great, great tool.
Absolutely. Appreciate you calling that out too. So Go Bag, we'll go back, I'll pin this video, but we did last Friday, like a few days ago, we did a call with FinLocker talking about the Go Bag and those tools there, the credit simulator and the situational tool in there. So check those out. I love that because the interesting thing about the models. Now, let's talk about models. We just said models. There's different ways to model credit scores. A mortgage model is way different than a consumer Old Navy credit card model, right? An Old Navy credit card model or Gap or the whole Banana Republic group, right? They want to give credit to anybody, including 18-year-olds with zero history whatsoever, because they're going to buy clothes, and clothes are a low cost margin of error. Let's call it error or cost. And so really they're like, oh, are you breathing? Do you have a social? And do you have any judgments against you? Okay, well, here's your credit card. Right. And it's not a huge balance, but a good card. But a mortgage model is way different. Jerry, you haven't spoken in a little bit. Let me toss this to you first. Talk about the mortgage model and how they maybe manipulate the numbers differently to give you that score.
So what they're taking into account for most of the score models is basically a revolving trade line for a specific time frame. So when we're talking about credit and revolving accounts, they're looked at differently, right? So they're more about just consistency of utilization of overall credit lines, and then how much of that actually impacts your ability to pay consistently. Versus on a mortgage, that's more looked at with more strength on the installment loans, where you've shown a history of being able to make a consistent, steady payment on a regular basis. And so when you start looking at that, it's not like the credit cards where they're using Vantage scores or they're using the FICO 9s, and I can't remember the other models at the moment. But when we're talking about credit for mortgage, it's if not mistaken, it's a FICO 2 and 8, and I actually have a TikTok video about this that I made like a month ago, but I specifically talked about that being the thing. It's like they're not the same. Every score model has its own feature for that's more driven to focus on that particular type of payment. The car loans, they have their own scores as well, so they're all divvied out differently because they are just specifically looking at smaller installment payments, right, versus the larger installment payments like a mortgage. So obviously that has a definite change in the effect of how it's categorized, how it's reviewed, and ultimately how much that strength of buying power it gives you moving forward with the scores that they give you. So that's kind of how they differentiate the three different styles of rates and payments and scenarios that they review in order for them to give you, where you categorize in that score model.
Yeah, Jerry. So is that why sometimes people call and say, "Hey, I just went to
Credit Karma.
I wasn't going to say it. I
Necessity.
just went there and they said I had an 800 credit score. Can I buy a house?"
Right.
Yeah, and that's exactly why the misconception is there, is because those are all based off Vantage scores, right? So they're geared to try to get you in with credit cards. And I mean, it's funny if you think about it. Look at those credit agencies that are being used for that, right? They say they're using Experian and Equifax or whatnot, but when you look at it, they say they're using the Vantage scores, right? Because all they're looking at is the way you utilize a revolving debt. Why? Because they're also suggesting to you at the same time, hey, look, these are all the credit cards that we have aligned with us that you can qualify for, and we want you using our trade lines versus using, using a retail bank credit line or whatnot, right? A credit union's credit line that they can give you on a credit card. It makes a difference for them too, because then it drives more business in for them. So again, they're gearing that information so that way you think that this is the source versus apps kind of like MyFICO, right? Because MyFICO will give you the actual segmented, broken down credit scores. And yeah, there is a fee to those, right? Like there's always going to be the apps that actually have real use to them, that there's a fee and a cost for. So having stuff like our GoBag comes into play really well, because now it gives you that source of information without you having to actually come out of pocket for the majority of that stuff. So it's just something to keep in mind when you're looking at all these other apps. Like, yeah, everyone thinks Credit Karma is like, like the end all be all for their credit score. It's like, no, it's not even close.
Even
it's
worse
great
than
for
that.
credit cards. That's about it.
Is Credit Karma does it right. Different companies do it, but also Experian and Equifax. Like I've signed up for their monitoring stuff, and I'm getting pitched like, "Hey, you've got $39,000 worth of credit. You should roll it over here." And I'm like, I don't want to. Stop trying to get me more in debt. Solicitation is a real thing, and I'm tired of it, which is why VetaVA is totally against solicitation. We will not use and or partner with companies that are going to solicit you or sell your information out there to get solicited by somebody else. Man, gets all up in my.
Yeah.
Grr.
Oh yeah, because
All
they
right.
sell everything about you.
Let's talk about fixing our credit, right? So you pull a model, great. All right, we're going to talk about models, and I'm really excited. In the near future, we're going to have some announcements that for VetaVA, anybody that is even interested is going to have access to this, some training and some stuff. But I can't really say much more than that today. So keep an ear open. But let's talk about some models. And we got a question. I'm going to say Brandy asked it, which Brandy's part of VetaVA. She knows, but this is a good question. Like, I like this question. So let's talk about it. When I make a payment or pay off a debt, it usually takes a while to update. So our loan officer is able to see an updated score faster than what I see when monitoring my own. And let's go a little bit into how we handle that on the URLA, the Uniform Residential Loan Application. Who wants to take this one on? I'll take volunteers.
I can jump in.
All right. All right, Jerry.
So just because I literally have been having this conversation uber times over the last month here, but yes, we can see more current data than what you see as a consumer, because your credit score typically only updates once a month, kind of thing. But when we pull credit and then let's say there is a high balance that's still remaining on there and it hasn't updated, there's ways for us as lenders to be able to submit a request for rescore based off of updated balances and essentially providing up-to-date statements, or if there isn't a statement available yet, depending on the agency, there may be some that'll take on just your proof of payment based off of the transaction history, with URL coded at the bottom of the page, and then they'll update that score. Or some of them will require you to actually have a letter from that particular investor that states that your balance is now zero or paid down to X dollar amount. And typically we would do something like that if we're running into a scenario where our ratios are extremely tight, where it's approving and not approving on a loan. And ultimately, if we just pay down a balance and then ultimately that payment drops, that could be the difference maker between qualifying and not qualifying anymore. So those are the scenarios that we look at, and those are the ones we utilize in order to go ahead and bring down those balances and ultimately get that score to update with lower balances or even a better score, ultimately affecting the pricing and ultimately affecting whether or not that loan qualifies as well.
And one thing that I've personally learned about when it comes to credit cards, that type of revolving debt, is to understand the difference between when the credit card company is reporting your balance. Like, where is that day that they decide this is going to be your statement balance? Because when I had looked at mine just to see how different it is, I know for a fact the 13th of the month is the last day of the month in my bill cycle. That's what I'm looking for, is bill cycle. So on June 13th, which was yesterday, that was the last day of my bill cycle. My statement isn't due. My due date isn't due till July 7th. So understanding where that is can help you know when it comes to making payments. Like, if your purpose of making the payment is to, say you're at 80% and the purpose of the payment was because you need to get your credit score to a certain thing you've done, you've worked with Anthony or Jerry or me or whoever, and you've been in the go bag and you're doing the simulator, and all of a sudden you're like, why didn't it work when I made you're basically going to go a whole nother bill cycle before you see
The impact,
the benefit of what you've done on your score.
Right.
So learning when day 30 is very important.
Now, when it comes down to reading a credit report too, we're going to get into more of that. But I'm actually looking at comments. Sorry, I started with a question. I'm going to sideline myself here. Any comments here? Oh, is the credit score updated with a credit supplement? Let's get into some lingo. This is asked by a professional. Come on, Serena. We know you. You're VetaVA Pro. But that's a good leading question. Anthony, I saw you shake your head. Yes. Give everybody a definition of what she's talking about.
Yeah, so I was thinking about this when Jerry was talking, because from a lender standpoint, a credit supplement is when something on the credit report may not be correct or the balance is paid off. We can go in and get that information updated for the underwriter, but it doesn't impact the score unless we go to what Jerry was talking about, and what our lingo is a rapid rescore. And so we tell the credit agency, not only do I want you to verify that the balance is now, $100 instead of $5,000, I want you to go out and run the rescoring model and give me what the new credit score is. We just had this scenario 2 weeks ago because I'm sure I'm going to lead into you for you, Nathan. I had a client that they had a 658 credit score, and the model told us if you pay this one account down, it'll raise your score 15 points. And so normally that's not a big deal, but in her case, there was a rate break at 660. So at 658, she had a higher rate than what she would at a 660 score. So we did the credit supplement, got the balance down on the credit report, and then we had them go and rescore it. So now our pricing model is based on a 663 credit score instead of a 658 score. And so she got a better rate just because of that change in her dynamic. And it was the difference between a rapid rescore and a credit supplement. And the supplement doesn't really impact the score. It does impact the credit underwriting from a underwriter standpoint.
Nice. Yes, man, you led into something good, because the question is, if the VA doesn't have a credit score requirement, but they have credit history requirement, and I still want to get this, but the lender has what, Anthony, what you called out was the lender overlay, right? They're the ones who are going to say, our risk tolerance is going to allow for credit scores of this. Now, by saying, by the way, they're using actuaries, which are amazing mathematicians who literally look at a ton of data and say, hey, based on a whole bunch of data we have, we know we can verify that historically anybody with a credit score of this will probably end up paying their bills on time within a certain margin of error that the lender finds tolerable. So that's how they come up with these numbers. Well, it's really not just like guessing, like, I think it's this. It's actually data specific. But Anthony, lean into kind of where you just started that, and then hand it off to either Ben or Jerry. But why in the world would credit score impact the interest rate, and when is it a special time to focus on that? Why would I focus on it?
Yeah, so historically, to your point, the credit score really is a risk model. If I'm going to lend somebody $200,000, what is the risk that I won't get that back? Mm-hmm. And that risk has to be offset by the rate of return on that investment. And so from a lender's perspective, if there is a high likelihood that I'll get my money back on time, then my risk is lower, and I don't mind allowing that transaction to be at a lower rate. If the risk is that I'm going to get my money back slow, or maybe not at all,
right,
then with that higher risk, I want a higher rate of return on my investment as a lender, my investment to that buyer. And so when the model says, they're a 620 FICO as opposed to being a 680 or a 750, right? So we see that a little bit different on VA than what we see on conventional, but conventional, it's really tight on what those credit score breaks are. and how that translates into rate, right? Ben, you want to share about how that looks when we as a lender run pricing
Oh yeah.
and you see those credit score breaks?
Yeah. I mean, obviously, or maybe not obviously, but credit score is not the be all end all, but it is the subject of this Facebook Live. So, to what you were saying about the different breaks, in general, or actually, I don't think I've ever seen pricing where the breaks didn't come in increments of 20 points on credit scores. So, like you were talking about somebody at 658, our first thought is when they're looking at improving credit, our first thought is 680. I mean 660, I'm sorry. Like that could be very attainable. And we know that that's just 2 points, but that could be a big difference. Or they're at 622 or 637 and we know 640. So it's not the 620 to 630 to 640 to 650. It's usually, isn't that what everybody pretty much sees, right? Yeah. So it's not, you can kind of self-assess sometimes if you do an application and your loan officer says, all right, so we did the tri-merge credit, which is the 3 credit bureaus that we use, Experian, Equifax, and TransUnion. And then we take the middle score. It's not an average of the 3 scores, or it's not the total divided in 3 an average. It's the middle score. That's the score. And then we say, okay, good news. You got, 652. And here's what we're looking at. Immediately if you've been in our group, is there anything I could possibly do?
Right.
Like that's a great question, because now if there are times, the process, I have to say this sometimes to people because I get excited when I see opportunity because I know if these things happen, they're going to save money, and they can buy the same property for the same amount of money, but less out of their pocket. That excites me. And sometimes I have to stop myself and say, I'm sorry if I made this sound like it was going to be easier than it was. The process, if followed, to do a rapid rescore is proven. We know how to do it, within a few points of error, but it's not super quick. And it obviously does take very specific sequence of events. So sometimes people are in a very tight spot. They've got to close on their home in 22 days. And sometimes you have to, as a loan officer, really break it down and say, we're not going to be able to get this finished, and to the closing table in that time frame. Now, if somebody said, they've got a 45 day, they've got 60 days, it's like, okay, let's, and each situation is specific, but I don't want to get off on that and discourage people, because it is very possible, especially if you haven't started the home search. You started the application, the pre-approval process, you have time to work on something. That's a golden.
So
Yes, so
I think that, oh yeah, go ahead, Anthony.
Just real quick, since we're talking about rate spread, right? We've seen rates just
I just giggled.
Is something going on?
And go straight up the hill the last 60 days. So just for fun, so if somebody with a 600 credit score, are they like 4%? Well, no, maybe that would be backwards. A guy with a 600 credit score is like 8, and a guy with 700 is like 5, and then a guy with 800 gets like a 2% rate. Is that the way that works?
No. So in these particular scenarios, right, we're talking about it's what they're called loan level pricing adjustments, right? And it's based off of the FICO scores. And the FICO scores really, we're talking about at times somewhere in the ballpark of about 1% difference or in rate or cost, right? So it really just depends on what you're looking at. If the goal is a certain payment, you can get them that certain payment they're looking for, but at the same time, it might require them to pay more money to get that rate. And depending on the FICO score, like we were talking about a few minutes ago, which was what tier are they in on their credit? Like, are they at, are they in the 640s right now? and how obtainable or how close are they to the 660? Like, are they at the high 640s? Can we get that 11 points? Is it possible? If we're in the 650s and high 650s, but we know that there's some things on their credit that, hey, if we just kind of work on these right here, this might bump you up over 680. We run the what if scenarios on the Wayfinder, and then it might determine that they can. I'm working with a client now that that's exactly the situation we're looking at. It's a 23-point swing. And yeah, it might take a couple of weeks. In their case, they're already under contract. So yeah, I mean, you might have to, run with the score the way it is now at the cost it is now, and then hope that you can get that rescore back in time before it closes. So that way you can get that rate, that cost reduced. And so those are kind of like some of the games that we have to play when we're trying to make sure that credit worthiness really appears to the lender, so that way they give us more breaks for that way we can save the veteran money in the long term.
But the 23-point swing to go from 650 to 670, that's not going to change your rate from a 8 to a 3. Right?
No.
You're talking about from a 6 to a 575 or 5625.
5.625 maybe.
Yeah.
But it definitely makes a difference on the cost. That's where it comes in.
And so, okay, so the rate has impact, or the credit score has impact on the interest rate possibility. The interest rate has impact on your monthly payment. The monthly payment has impact on your cash every month, right? Like, how much money do I have? How much month do I have the end of my paycheck? And you're really trying to be like, look, I want to balance the right way. What we don't want to do is, when we say we're house poor, I mean, all my money goes into my house and none of it goes into anything else, or to such a degree. In fact, I just saw something on one of those hot off the wire presses today that credit utilization is skyrocketing right now in the face of recession, right? So we're looking at inflation. We were already kind of living, credit usage was really low for the last number of years, and all of a sudden it's bumped up because why? We're adjusting slowly to the demands of the marketplace, myself included. So I'm not preaching to anybody but myself here on this one.
Was that the graph that showed the consumer credit going up, the revolving, at the same time showing the personal savings rate going down?
Exactly, right? Because we're offsetting ourselves, and it's like, all right, so we're going to impact your credit scores. Now, utilizing your credit's not a bad idea, but having that credit for too long of a time and not being able to pay it down, paying the interest rates on long term, right? The Fair Credit Act, and now it says, hey, if you keep this minimum payment, it's going to take you 17 years to pay it off. And you're like, it's only $600, right? Like, it's sad. I hate it, but that's how it works. So let's talk about the credit. We talked about the credit usage. I want to talk about managing and strengthening your credit, especially in times like this when we're like, I got to use it. How am I going to take care of it? Where do I find the balance? So let's chat that out. Let's talk credit lines. Let's talk interest rates, not necessarily mortgage interest rate. Let's talk credit interest rates too. Like, have that dialogue. Who wants to start?
As far as managing, like, if you've already not necessarily fixed, but you're just in the daily grind of life, and you're trying to maintain at least your credit score, right? Is that what you're talking about?
Absolutely, yeah. Like, I don't want to get upside down coming into this market we're in. Like, how in the world am I supposed to maintain a good credit score, but at the same time
I'll tell you what my number one recommendation is.
Yeah.
Make sure to, as regularly as possible, maybe not every month, but at least I'd say personally, every quarter, make sure that there's not inaccurate information on your credit score or on your credit report. It is your credit report. And, if I don't know why this analogy is in my head, but if you've got 3 kids and for some reason there's a 4th kid running around your house for a week, like that, there's something different in your house. So your credit, like, something's not right here. Somebody left their kid, I don't know, but that's that's just how my mind works. Sorry,
It's
but
summertime, man. It's a good analogy. Like I used to hang out at my buddy Darren's house like
Right?
all the time, and I think his
right. And your
mom used
mom's
to
like,
count
if
me.
you want to stay there, just kind of hide in the shadows, don't drink too much Kool-Aid.
Right, exactly.
But if it's important to you, all of us on here have seen obviously inaccurate information, like
Yeah.
obviously a real life example, a personal friend. He's the white New Balance guy. He's an 800 score. and right, you understand that, okay?
We just
And he
talked about
applies,
this.
and his score is like six, high sixes, and I'm like, okay, well maybe, and I'm looking and I see a no joke $40 copay, but I didn't know what it was, a $40 collection, which I think this is a good segue to a new thing happen tomorrow, but
Okay, yeah.
a $40 collection. And I looked at it and it said medical. And so I asked him about it. We figured out that if he could actually pay the doctor's office directly, they would cancel it with the collection company and delete it from the report. Guess what? As soon as we did the rapid rescore, he went back to being 804, over $40. It might have even been 20, but I'm saying 40 just to be safe. So inaccurate information. Or Jerry, why don't you share what you and I were talking about earlier today about how inaccurate information can get on there?
Yeah, I mean, like at the end of the day, it's like if you have a trade line that's sitting with a high utilization or whatnot, and somebody already made the payment, it's like, well, dude, like, yeah, like there's inaccuracies there. There's people that have gotten judgments put on their credit, and it's not even the same person. It's like the names don't even match up, or maybe the names match up, but they're not even the same individual. They're different social security numbers and everything else. So there are inaccuracies. I mean, there was a bunch of stuff on my credit report a couple of years ago that I was just like, what in the world? And I just never paid attention to it. So I say this personally speaking, like there's sometimes a bunch of missing details that if you bring it to light and say, hey, you know what? Well, this liability that's showing up as a collection on my credit history, that never happened because I'm not this individual. I never lived in the state or whatnot. And all of a sudden you can go ahead, and if you're working with someone or if you're doing it yourself, you can dispute those and get your credit cleaned up, right? But ultimately, I think that the biggest thing is what's about to happen. If I understand correctly on the date that it's supposed to take effect, which is tomorrow, medical liabilities that went into collections are no longer going to impact your credit score. So that's going to be a big one for a lot of people that have had a lot of medical debt, and it's been holding their credit scores really low for a really long time. This is where we're going to have that opportunity to really see some of those scores potentially just jump.
Right.
So, I mean, a lot of that stuff really is going to be the difference maker for a lot of individuals starting tomorrow. So,
yeah, because people who paid their collection, here it is, popped up. I'm trying to be responsible. $150. They paid it. It's still on there. It just says zero balance. That still negatively impacts their credit. So those people are going to benefit greatly from that.
Yeah.
So let's talk about that. So managing, there's a couple tools. So I'm just going to show my screen because I can't share my cell phone. But if you didn't see the Go Bag, see that app right there? It's kind of fuzzy. That's my dog in the background, by the way. The Go Bag, you can actually look at your credit reports in there, powered by TransUnion. Look for lines of credit. It gives you a soft score, right? It gives you the Vantage score like we talked about. But I pay attention to the lines of credit. Any new ones that I didn't open, any inquiries I didn't make, anything that is reporting that shouldn't be reporting or isn't reporting that should be reporting. Okay, I think I said that right. All right, I'm checking for those on a monthly basis, and mine updates on the 24th of every month. So I usually go in the month. I'm just checking. Yep, looks right, looks good. My utilization might be off. I decided to move some money, make some payments, and whatnot. That's how you're going to manage, and then you're going to strengthen by running some scenario bases that we talked about already. I want to answer a couple points that popped up here. I'm just going to read one off. Somebody says, I have one debt and a car loan and one debt and a consumer loan and one credit card, and I have a terrible score. All my balances are zero. Suggestions, Veta VA reps. suggestions. So they've got
that to me sounds like, okay, you have an installment loan. How long has it been open for, right? Has it been over a year? Has it been over 6 months? That's usually going to give you a little bit of a boost. The other thing is on the credit utilization. If it's constantly at zero, that's also a problem, because if you're always carrying a zero balance, it shows as if you don't really have much credit. So you want to carry anywhere between anything under 10% would be ideal. Because it's minuscule in comparison to your total credit availability, and then ultimately it impacts how credit agencies and the credit bureaus look at you, because now it's like, oh, you actually use the credit cards and you're only carrying about 10%, and so you're having that number consistently be under 10%, even if you use, let's say, you have a $500 credit card, we use $350 of it every month. But by the time you make the payment, you're only down to, let's say, $50 that you're carrying. That now you're sitting at 10%, right? So they're going to look at that and say, okay, this individual's not only utilizing the credit, but they're being responsible with how they're using it. And that now you look better for the credit agencies and the credit bureaus to then say, okay, that's gonna boost your scores. That's going to continue to help you look better. And then if you are able to make what they call like semi or biweekly payments, that also has usually a very good effect. So if you just time it right, essentially from the date that your statement is due, 14 days in, make a payment, and then about 10 days later, you make another payment. Give yourself about a 4-day window for everything to update by the next time that the payment cycle and everything's reviewed. It'll actually look like you made 2 payments, so kind of in a sense tricking the system per se. And
that's not a guarantee. It's not a guarantee, but it's a good.
But it's got a good track record of showing.
Yeah,
it's a good track record where it shows a consistency of being responsible with your trade lines, and ultimately makes your credit scores jump.
Yeah,
Anthony
and to
Patton went
that
off
point, sometimes that's what the Go Bag helps with. It can run that algorithm and tell you what's wrong. Sometimes it's a time issue. To your point of it not being long enough, sometimes the algorithm doesn't have enough time on the credit to give a higher score. So it may be a 3-month waiting period or 6-month waiting period. I don't know if the Go Bag has, but our model has what happens in 90 days, what happens in 120 days. And so it can kind of tell us if this is a timing issue also. And it will also tell you, like in this case, if you've only got one credit card, maybe the system is looking for another one. And so that it's to your advantage to open another secured line or another secured credit card and run that for a couple of months, because that's what the algorithm is looking for. The system will tell you which one is going to best benefit you in the long run, right?
And to what Jerry was saying about how, paying or whatever, having a zero balance means that your statement balance is showing zero. So you can still, make that 2 weeks in payment, and then you just, if you're trying to increase a score like what you're talking about, then, and you're used to paying it off, leave $10 on so that the statement shows $10. You're not going to get charged interest as long as you make that $10 payment before the due date.
Right.
So he's not saying carry a balance in terms of getting charged interest. He's saying that if it's been zero, we know that's not working. So show 10.
Yeah, show some usage. Okay. We talked a lot about kind of jumping back and forth. I'm watching for some more scores coming in there. Utilization for that one, I think that's great. Let's go back to some history. Who was ready for history? How long has our current credit score model been in place?
Which one?
Question.
Aha, right. Oddly enough, it hasn't been. We are not even out of like 40 years from the Equal Credit Opportunity Act, right? In 20. Oh wait, are we? No, that would have been 40. Yeah, I'm sorry, 50 years. 50 years out. It was 1974 when that passed. Okay, that's a harder one. Let's go back a little bit farther. How did credit in the United States actually originate? Who wants to tell a story? All right, Ben, you start us off. We'll do it. We'll do story time.
Oh my goodness. It goes way back. I mean, I'm sure credit existed,
Hold on. Let me just share that Ben totally geeked out over this, so I love this. So go. I loved it. We talked about it for like an hour. It was fun.
Yeah. Credit is biblical, right? So they talk about it in the Bible. There's credit.
Right.
There's a year of Jubilee. Like, it's been around for a long time. But what we talk about for credit, the way we use it in the U.S., like, what's the U.S. history of it?
So the U.S. history, sometime in the 1800s is kind of when I think the one of the three that we use currently, Equifax, has actual like charted history back the farthest. I can't remember what it was called originally, but TransUnion came from it was a railroad company. Basically, there were multiple credit reporting systems or ledgers or gossip columns, whatever you want to call them, and they were shared between merchants of like industries. So if I'm running I don't know, whatever, a horse shoeing, what do they call those guys? Blacksmith. I'm a blacksmith. I'm sharing with all the other blacksmiths.
Sorry, guys. No, they're farriers. A horseshoer.
You're right. I have
farrier.
Right.
Thank you. Yeah, the person who makes the horseshoe is a blacksmith. Come on, you are in Tennessee. Like, I'm new to Texas, and I got this one.
Well, that's me just trying to come up with examples out of the air. So there you go.
But we would have had the questions ahead of time. It would have helped.
Oh yeah, sure, whatever.
But so different industries. I mean, that's easy enough to understand. Would share. Now, what really happened was they weren't sharing very much positive information. They were basically just sharing a lot of negative information. And over the years, some, acquisition, is that the right word? Mm-hmm. Where they would sell to each other. And believe it or not, even before the 20th century, they were selling your information to other people.
Yep.
Solicitation is part of our fabric. Anyways, so all the way up to, let's go all the way to 1960. Mm-hmm. By 1960, there were 1,600 different credit repositories, so to speak. And that was when a lot of that acquisition happened. There was several legal matters. The government was involved, and that all kind of came about with the is it called Fair Credit Reporting Act?
Well, that was part of, that was the reporting piece of it. That, so
right.
Yes, you're right on that part. That's not
when they
credit.
Started
that
the Fair Credit,
mm-hmm.
Fair Credit Reporting Act in 1961. That's when a lot of the conglomeration happened. That's when a lot of the smaller ones, because they couldn't meet the guidelines of being fair.
The systemization came together because it literally was like you're talking about. It's like it was small town. Credit was issued on a small town benefit, right? It's like layaway was an aspect of credit. Credit was, hey, I'm going to take this now and you owe me, and if you don't give it to me, I get to recall certain aspects of your land, even like your cattle and everything else. But it was literally a creditor or somebody issuing credit to a purchase to a consumer could literally go into church and say, hey, do you know Jerry? Is he an upstanding individual? Like, is he worth it? He wants credit in my store. I mean, that's what it really took. And so the Fair Credit Reporting Act did basically say, look, for all this information we have, Sears, Roebuck had their own and all these others, and they'd start, okay, let's put our arms around it. Interestingly enough, in all of that Fair Credit Reporting Act, it definitely shone a light on redlining. It shone a light on everything, and it showed a massive light on the fact that women could not get their own lines of credit, pregnant women especially, and unmarried women. Right? That didn't actually get addressed until 1974 with the Equal Credit Opportunity Act. And guys, I figured it out. It was Lindy Boggs. You know what the funniest story about this whole thing is? So the Equal Credit Opportunity Act was positioned and it covers. I have to remember. It covers race, sex, gender, ethnicity. What am I missing? Equal credit. There's one more, isn't there? Come on, brain.
Did you
There's
say
one more. I'm
gender?
gonna think about it. I did. Race, sex, ethnicity, gender, marital status,
Mhm.
and religion,
Religious?
right?
Yeah, I think so.
Or is that housing? Fair housing. Anyway, oddly enough, in the initial bill that was put forward for equal credit opportunity, marital status and gender were not included. And so, what was interesting in that whole children. That's it. Marital status and children and family. So, Lindy Boggs, in the midst of the final vote for this to pass, quite literally sneaks into the house. She was a representative. She sneaks into the house and she added into the bill every desk. She slid in there that it would cover marital status, right? So they couldn't say you couldn't get credit just because you weren't married or that you were pregnant. It literally, she snuck it in there. She snuck it into the bill. It is the craziest thing. If you should look up the story, and so they all vote on it and they pass it because of what it was. They didn't read it the next day, and then they're going through the bill and they're ratifying it, and they go, wait, there's something new in here, and it passed because they had already voted on it. So sneaky, but it was good. It was good stuff. So credit has a really weird history, and it's crazy stuff what it has out there. What have we not
Okay,
talked
so
about for credit?
since you've been talking about history
Yeah.
and we've been talking about credit,
Yep.
something else changed, right? So a couple of years ago, they came out with the idea that, well, what about my bank accounts?
Yeah.
What about my rent? What about my utilities? Why can't those factor into my credit score? And so recently that has changed, and it's really kind of bizarre that we have these three companies, Experian and TransUnion and Equifax, and they do it different ways and they do different things. FICO has you can add your bank statements in and your banking history as to whether or not you keep a positive balance. And so that'll impact your score over there, but it doesn't help your Equifax or your Experian score.
Right.
And then you can go to Experian and Equifax, and you can get at Equifax, you can get your phone bill and they call it self-reporting, but it's not really self-reporting because you can't self-report. You can report your utilities and your water bill and your phone bill, and you can get that stuff reported over there, but it doesn't impact your FICO score. And so those are relatively new in history. And in fact, the old models don't account for the term self-reporting. That doesn't impact your score. It's only the new models that do. And so you got to go to Experian and get the self-reporting tool so that you can get your utilities uploaded. You got to go to FICO and get the Ultra FICO to where it will upload your bank statements and that statement history. And they all charge you just a little bit because nobody's in the business of doing things for free unless you're dealing with Vetted VA because it's free. So
yeah, that's right.
That's the other thing that historically we haven't had until just recently. And so that'll impact your scores if you have this low credit score or negative credit score issue.
Yep. So if you go back, that actually came out of IGRCPA, one of my favorite law acronyms ever. It's the Economic Growth, Regulatory Relief, and Consumer Protection Act, signed into law. I had to look it up. It was in 2018. So
Yeah.
what that did, actually, they wrote in a section of this law which said and opened up to credit issuing or credit bureaus to allow them to look for other lines to create credit strength or credit reporting structure. So that's kind of where it all came from. It's not. It's out there. There are multiple. Like Ben was absolutely right. There used to be 1,600 data sets on credit. There are so many multiple different variations of credit number reporting algorithms. We're just not all on the same one, right? There's a blend to them. So it's really intriguing that we're still dealing with the same old. But hey, I've got a couple of questions popped up, guys. I'm gonna throw this up here. So one I didn't catch right away. I'm sorry whoever asked this, and I feel bad I missed it. So let's look at this one. It says, any factors causing negative reactions with the denial of student loan debt forgiveness beyond undergrad programs? What are y'all thoughts? The way I read this is that they applied for debt forgiveness but was denied the debt forgiveness. So the debt
Is there going to be a negative reaction, a negative
yeah,
something on the credit score because of the
mm-hmm.
denial of the forgiveness?
Oh,
Yeah,
I would think not. Yeah, I would think not, as long as they're going into some sort of payment arrangement after the fact once they've been denied at that point.
Yeah, because I would agree with you. As long as you're making your payments.
Mm-hmm.
Now, if you're not making your payments, it's going to negatively impact your score, but it doesn't have anything to do with the fact that you got denied for forgiveness. It has to do with that you're not making your payments on time. And until this year, student loan forgiveness was not a thing. I mean, you had to pay it regardless. They were going to get their money, and it did a lot of damage to a lot of people's credit scores for not paying that.
Well, there's been a forgiveness plan if you were in a common good or a community good, like you work for a nonprofit or a certain thing, like you get some of it forgiven, but it was so hard, and if you applied, you weren't necessarily approved. So I agree. I don't know how negative it'll be if you're back at a repayment plan. There might be a hiccup, but I will say this from credit: the whole dialogue. We've kind of gone a little long. It's an hour 12 into this, but I will say this: credit, you can come back from bad credit. You can come back from bad experiences. It just takes time. So we have one more question here, and then we'll get to wrapping it up. But why is TransUnion Equifax not considered in mortgage markets? It's an interesting question. I don't think maybe we haven't explained it well enough. Somebody walk me through this one. Like let's counter this statement.
I kind of wonder, is that my fault for talking about the middle score?
Maybe because you called out Experian. I don't know. They are.
Yes.
Right?
Yeah, all three.
Yeah, we pull from all three, and that's what we call it a tri-merge, so that we're seeing this account, and it shows us, which viewers is reporting to. Hopefully, all three. And then when we, as loan officers, as lenders, look what is the qualifying score. It's not that that they're lined up by brand, by company. It's by score. So this one says 681, this one says 684, and this one says 702. 684 is the middle score, regardless of whether it's TransUnion, Equifax, or Experian. So all three are considered.
Because they're trying to be fair in that way of looking at it. It's always going to go based off that middle score. So you have a high, a low, and the middle, right? And they're going to give you based off that middle score.
Yeah, and I don't think that I have ever looked at, well, who was reporting that high score and who was reporting that low score. I think it's because every credit report is different. One time TransUnion's the high, sometime else TransUnion's the middle, a different credit score. A different client will have TransUnion as the low score. And, to your point, Jerry, we're always just looking at what's the middle number,
Yep.
not who
Not the
created that
particular
number.
agency. Right.
Now, if
Yeah.
one of those scores is drastically different,
Right.
I will pay attention to what credit reporting bureau that is, and then I'll look through to see. It's obvious that one is either reporting or not reporting something that the others are.
Something.
And I'll try to find it for you. The
Right.
black swan.
Yeah. When you say drastically, what do you mean by drastically?
I've seen 100-point swings.
Yeah.
Yeah.
Not swings, but differences.
Yeah.
Not usually, but when something jumps out, I'd say I personally, if I seen something, wow, there's your Tennessee. If I haven't seen something, then 50, just something that looks very odd. Why these two are so, neighbors, and this guy's way over here. That always makes me wonder.
You definitely have those outliers, and it's typically, like, at least in my experience, it's always been something where it's a particular collection account that may have been already removed from the other two bureaus.
Yeah.
And there's that one that's, with all honesty, it's already the middle score, but it still has that. I'm like, oh, you know what? Well, there's a possibility that we can get that collection removed. And once that gets removed, that score jumps up and is now bringing that score level up 30, 40 points. And that's crazy, but it's possible. It
I
can do
think majority of time, I'm the spread between high and low is about 20 points.
Yeah.
And sometimes a lot closer than that. The spread's, 5 points or 6 points.
Yeah.
Yeah, I've seen the randoms, and I agree with Jerry on that one. It's usually a negative thing that like wasn't removed, and again, when you get into that, now you're into Fair Credit Reporting Act, FCRA, FCRA, and FACTA, Fair and Accurate Credit Transactions, FACTA Act, and basically that's what tells. Then you work with the FTC, the Federal Trade Federal.
Yeah.
FTC, and basically they're the ones that regulate that, and so you have templates with these letters that you send in certified, and the credit bureau has up to 30 days to actually respond to you, not just have it and do something. They get to tell you, hey, so you send them your evidence,
debtor has
look,
to
this is
reply.
gone. What's that?
Yeah, the debtor. The
Creditor.
The creditor. Well, the creditor is the one, or whoever the collection account is through. They have 30 days to respond to that.
Right.
With whether or not it's factual, and if they can provide supporting documentation or whatnot, then it can be rebutted. Otherwise, it has to come off the credit report. So yeah,
Right. Exactly.
Well, I
And so
feel like
that's-
it's so important to check for inaccuracies
yeah,
on a routine
especially
basis.
on free tools. So go to vetedva.com/gobag or oh, bye, Jonathan. Jonathan Mercado.
sorry,
That's a
guys.
good- he's a
My
good guy.
business partner.
No.
He just likes to jump in.
I know. Well, hey, it was good. Appreciate it. Appreciate the comments tonight. Thank you, everybody, for tuning in. Jerry, Anthony, Ben, thank you so much for giving your time this evening and your time, as you do every squad day. Bravo Squad on point today. You guys have been serving the community, engaging with the conversations, and appreciate you guys doing that regularly. Any last parting shots for the good of the community?
No, I think just like Ben said, just kind of watch out for your credit. Make sure that you guys are paying attention to where you're at with accuracies and whether or not there's, anything that shouldn't be there that's there. Try to go ahead and get that cleaned up as soon as possible, and know where your baseline is really. I've been dealing with quite a few people recently that have applied, and I mean, obviously rates aren't the greatest right now, but that's where the market is, and at this point, if we can know where at least where you stand, where your baseline is, of where it's like, okay, you might not be ready right now, but let's figure out where your starting point is, so now we can basically line you up to get you back to where you want to be. If you're not able to even purchase a home for the next 6 months because you're still in the lease, whatnot, then we can arrange those things. But it's at least this is how we can know where your baseline is and how we can ultimately help you reach that goal of home ownership.
Well, Jerry said he had
Yeah, I
nothing
think
to add,
that's a
but he
great
sure
point
did.
because everybody may not be able to qualify today,
Mhm.
but we can get you on a path to get there.
Yep.
And help you help you buy a house in the future. And I will end on one thing that the first mortgage loan I ever closed was 20% down, 690 credit score, and the rate was 13.8. And they were happy to get it because
Yep.
that was the market.
Yep.
And so we are seeing some higher rates right now, but hopefully it's not going to get to 13.8. But the other thing I would add, Nathan, back to your point about budgeting, everybody's seen on Facebook of filling up their tank of gas, and what used to cost me $39 is now $129.
Right.
If you're putting that on a credit card, you just need to make sure that you're watching which credit card I'm putting that on, so that at the end of the month, you don't blow your budget up. And it is a miserable situation right now. And we certainly are all experiencing it. But just pay attention so that if this tank of gas needs to go on this other credit card, then, let's put it on the other one, and hopefully we'll get them all paid off at the end of the month, right?
Right.
So thanks, Nathan. You did a great job as always.
Oh. Ben, you
Well, my
got any
sign-off
thoughts?
Mine sign off is the familiar one. Keep talking about managing your own credit, your own report, and keeping on top of it. You might recognize this one. Trust, but verify.
Trust but verify.
Nice.
Love it. Well, guys, I look forward to seeing Jerry and Anthony at summer camp next month. If you all didn't know this, but Anthony is a shotgun wizard. That guy can bird with the best of them, and he's going to teach us how to do some clay shooting really good. And Jerry just comes and he likes to plink around on the 50 cal and get his 1,000 yards in. So, Ben, you're going to miss you this year unless you change your mind.
Right there.
No, got to hang out with my brother, unfortunately. But
All right. No, not unfortunately at all. We'll miss you this year, but hey, guys, thanks so much. Thanks for this evening. And if you have any questions and you're watching this on replay, please do put them down here. These guys are monitoring this, and we'll see your comments, or I'll make sure they see them, and we get you some feedback. With that, have a good night, everybody. Be safe, and ask more questions.